Okay, so still on the real smart money concept. We are still in the introduction phase. We are still in the introduction phase. So for today, we're going to address what is liquidity and how liquidity affects us as traders and how it's also used by institutions in their trading. So in simple terms, liquidity is simply, this is money. Liquidity is simply money, retail money. Liquidity is simply retail trading money, retail trading money. We can describe it like that. Liquidity is simply retail trading money. In what way? It can be their deposits. Your deposit can actually be used as liquidity by brokers. Your stop losses. Your stop losses can be used as liquidity. Your entry points can also be used as liquidity. So liquidity, this is what drives the market, what makes the market to go up and down. What makes the market to go up and down, up and down, up and down. For it to move like this, the market needs what we call liquidity. Liquidity, we can also describe it as the engine that runs the market, the engine that moves price. That is also another description that we can give to liquidity, is the engine that moves price. So without liquidity, there is no movement on the market. We wouldn't be having all these fluctuations or all these movements on the market if ever there was no liquidity. So, for example, we mentioned that deposits of retail traders can actually be used as liquidity by brokers in order to facilitate the transactions that they want to facilitate. So institutions and these big guys and these central banks, they actually use also, and these smart money guys, they also use stop losses. For example, today we're going to talk about one type of liquidity, which is what we call trend line liquidity. Trend line liquidity. Trend line liquidity, and also support and resistance liquidity. Right, as I said, liquidity can come in form of stop losses and also entry point. So we have two forms of liquidity under that: trend line liquidity and support and resistance liquidity. How does trend line liquidity happen? For example, you have seen oftentimes, many times, when you have your channel like this, let's say you discover that we are uptrending and the market is actually moving well in your favor. Market is moving well in your favor, higher high, higher low, higher high, higher low, higher high, break the trend line, test this low. So after the break of this trend line, you'd see the market going back up. These are some of the mysteries that are there behind the market. These are some of the mysteries, some of the secrets that are there behind the market that most of your mentors will never tell you. So most of you have been taught that after the break of the trend line, you sell. The market is now downtrending. Yet it's not only the break of the trend line that determines that the market is now downtrending. That is only one factor which actually carries a lot of loopholes. It has to break the trend line, yes, but it also has to break market structure. If ever it fails to break market structure like this, also has to break market structure and also collect liquidity for us to fully say we are now downtrending. So in this case, you realize that the market is still an uptrending market, because this is a higher high, higher high, higher high, higher high, higher low, came back to test this low. So it's still an uptrending market, but most the retail traders, they are already trapped because they are busy selling. If they are selling, the market comes, tests this, it comes and tests this law here. In upcoming episodes, you realize that on this law, we'll actually be having a demand zone, which what you guys can also call an order block. Somewhere around these levels will be having an order block that the market will be coming to test. Coming to test that order block, it will actually be collecting trend line liquidity, because as retail traders, what they are used to do, they buy here, they buy here, they buy here, and they buy here. So meaning below this trend line here, there's a lot of money that is below here, because after buying there, your stop loss is just below, just below, just below, just below. Your stop loss is just below there. So as institutions, they're also aware of that. They're also actually watching you and actually seeing you buying there. After buying, you place your stop loss below. So what they're doing, they're collecting liquidity in form of these stop losses that you've just placed below your trend line. They come collect the liquidity through your stop loss,